Welcome to our lecture on interest rate fundamentals. Before we begin, a brief note about copyright and trademark. The outline of this lecture is as follows. We will start with the term structure of interest rates, providing an example using bonds to calculate spot rates based on given bond prices. Next, we will discuss the compounding of rates and the concept of basis, a measure commonly used in various financial products to define the length of a year for interest calculations. We will then explore spot rates, including different measures such as zero rates, short rates, annual rates, etc. Finally, we will conclude the lecture with an explanation of forward rates and their significance. Let's delve into the term structure of interest rates. We aim to derive spot rates from bond prices, since these prices reflect underlying interest rates. In our example, we define a zero-coupon bond that pays only at maturity, so there are no interim coupon payments. You purchase the bond and receive a single payment upon its maturity. Assume we have 6 zero-coupon bonds with varying maturities. Each bond has a face value of $100, often referred to as par value. Each bond has a distinct price, as they have different maturities. These transaction prices are listed here. For instance, consider 1, 2, and 3-year bonds. The 1-year bond is priced at $94.88 today. You buy it now and get $100 back in 1 year. A 2-year bond costs $90.75 today for a $100 return in 2 years. Similarly, purchasing a 3-year bond for $87.25 today yields $100 in 3 years' time. We also have examples for longer maturities up to 6 years, for which you would pay $77.63 today and receive $100 back after 6 years. From these prices, we can derive a term structure of interest rates. We assume that there is no credit risk in these bonds. First off, we need to clarify what type of rate we are calculating. In this case, we use an annual rate with annual compounding to establish our discounting methodology. The formula for determining spot rates are, for different maturities, is P, the price, is equals to 1 divided by 1 plus R to the power of N, where P represents the bond price and N denotes the number of years until maturity. Using this formula, with P as the known price and N as time in years, allows us to calculate R, the spot rate, for each bond's respective maturity period. For example, plugging in the price of $94.88 for our 1-year bond gives us an annual rate with annual compounding of 5.4%. It's crucial to understand that this rate isn't arbitrary, but rather derived from an actual liquid market instrument, the traded bond itself. Similarly, based on current market prices, $90.75 for 2 years and $87.25 for 3 years, we can determine corresponding annual compounded spot rates of 4.97% and 4.65% respectively. Continuing this process through 4, 5, and 6-year bonds reveal that due to market pricing, for instance, selling at $77.64, the implied 6-year rate stands at 4.31. All these calculated rates share common conventions. They represent an annual rate with annual compounding. If there were discrepancies between these calculated values and market conditions, arbitrage opportunities would arise. For example, If a bond price was lower than listed here, then I could borrow money via a loan at that implied interest rate, buy the bond at the lower price, wait until maturity, receive the par value of the bond, and pay back the loan for a risk-free profit. We are not planning to talk much about arbitrage and take the avoidance of arbitrage as a given. But if there is interest, then please leave us a comment and we will look into adding material about arbitrage. Let us proceed and discuss compounding. Compounding refers to the process whereby interest is earned, then reinvested, leading to the generation of additional earnings. This typically occurs multiple times in a period, resulting in exponential growth rather than linear growth in the interest accrued. There are various compounding conventions which pertain to the frequency of compounding events. For instance, these can be annual, semi-annual, quarterly, monthly, weekly, or daily. Nowadays, daily compounding is quite prevalent. Daily has become the most common convention since LIBOR no longer exists. LIBOR has been phased out and now we have SOFR. SOFR has taken over as the primary benchmark in the United States. SOFR is an overnight rate, making it logical and intuitive that an overnight rate would be compounded daily for a given interest rate period. Additionally, there's continuous compounding, which is primarily utilized within quantitative models. While not seen in actual markets, continuous compounding offers significant mathematical convenience for these models. The conversion from one type of rate to another, for example from an annual rate to quarterly rate, is beyond our scope here and will be left as an exercise. However, we aim to provide some insight into compounding in the next section through an example involving an annual rate with quarterly compounding. So, as I just mentioned, we illustrate the concept of compounding using an annual rate and use quarterly compounding to calculate the interest. In this illustration, PI represents the principal after I compounding periods. So, P0 is the initial principal, and P2, for instance, would be after 2 periods of compounding. Here R denotes the annual interest rate. This is a simple annual rate, and I represents the interest accrued. Let's demonstrate how much principal would accumulate over 1 year with quarterly compounding. After 3 months, we begin with P1, which reflects 1 quarter of compounding. So P1 equals the initial principal, P0, plus any interest earned during this period. The interest I can be calculated as P0 times R divided by 4, since it's only for 3 months. Therefore, we have P1 equals P0 plus P0 times R over 4. By factoring out P0, we find that P0 grows by a factor of 1 plus R over 4 to give us P1. Now let's move on to the next period after 6 months. Remembering that P0 is our initial principal and knowing that P1 is from our previous calculation, we want to determine P2. Similarly, P2 equals P1 plus interest of P1, where again we calculate interest for a quarter period using our established formula. Continuing this pattern through subsequent quarters leads us to realize that with each new period, we are calculating interest on an increased principal amount due to prior compounding. So we end up with P2 equals to P0 times the interest rate growth formula squared. I will let you digest this derivation for a few seconds before moving on. Now, we are reaching our third quarter. After 9 months, we apply our definitions consistently to find that each new value of principal, Pi, becomes a function of both time and compounded growth rates from previous periods. We aim to compute P3. P3 is simply P2 plus the interest, which we know is the growth rate times P2. Now we do the same steps as before, where P2 is replaced by our previous formula. Consequently, at the end, we arrive at P0 times 1 plus R over 4 raised to the third power. Moving forward to the 1-year time step, which is the fourth compounding period, we determine P4. At this juncture, I'll provide just the final result, as you probably have seen the pattern. It is P0 multiplied by 1 plus R over 4 to the power of 4. The pattern that emerges is that interest is consistently computed and then compounded upon itself, leading to an exponential effect, which repeated multiplications applied to the same term. Ultimately, the end result for multiplying compounding periods is that Pn equals P0 times 1 plus R over n raised by the nth power. Here R represents the annual interest rate. N denotes the number of compounding periods per year. The initial principal amount is represented by P0, while Pn signifies the value of your principal after n compounding periods. When considering rates, understanding the frequency of compounding is important, especially as SOFR is a daily compounded rate, and you should always be aware what type of rate you're working with. Now let us delve into basis. To illustrate how basis can impact calculations, consider an example involving accrued interest with differing outcomes between a money market deal and a treasury bond. Imagine a financial instrument commencing on January 5th and maturing on July 5th, a 6-month period spanning January through July. Comparing two instruments both offering a 1% coupon rate, firstly a money market trade with a 1 million principal, multiplied by 1% yields and interest calculated using a basis that prescribes specific numerator and denominator conventions, resulting in $5,027.78 due to a day count traction of 181 over 360 days. Conversely, applying these calculations to a treasury bond, also carrying a 1% coupon, results in a different value due to only counting 180 days within this period. A discrepancy arising from distinct day count conventions between money market trades and treasury bonds. This difference stems from varying basis definitions, which dictate how you calculate the length of a period for interest rates as a fraction of a year. It's essential for determining cash flows. In essence, cash flow calculation always involves multiplying notional times rate times basis. You can remember this term, which also sometimes is loosely used as notional times rate times number of days divided by basis. This remains consistent across all interest rate cash flow calculations. This year fraction consists of a numerator and a denominator where the numerator signifies the number of days within the specific interest rate period, and the denominator typically represents the total number of days in a year. There are various conventions for calculating this fraction, which define how to determine both the numerator and denominator. As previously mentioned, the numerator is calculated by counting the days from start to the end date. For instance, one might simply count every calendar day, ignoring weekends and holidays. So if we consider Friday through Monday, you would include Friday, Saturday, and Sunday in your count, totaling 3 days. Alternatively, one might assume a standard length for each month, assigning each month exactly 30 days, regardless of its actual length. If you're calculating within a single month, you would only account for that specific day count. Another convention is to consider only business days, which is, for example, common in Brazil. Naturally, your choice of numerator affects your choice of denominator. The basis used must be consistent between them. For instance, if you're using only business days as your numerator, you can't divide by 360 because it wouldn't reflect actual business days. Instead, you would use something closer to an average number of business days in a year, around 250, as your denominator. Common denominators include numbers like 360, or perhaps even leap year adjusted figures such as 365, or even other bases like 252 for purely business day calculations. While there are numerous bases used in financial markets, perhaps 20 or 30, the most prevalent ones include actual 360, which uses real calendar days divided by 360. For corporate bonds, often 3360 is used. And then there's actual, which is another standard convention. These 3 examples illustrate some typical bases employed in finance. When encountering these terms in practice or systems that already recognize them, it's crucial to understand the implications for accurately determining cash flows and valuations. Lastly, there's also the number of business days in the period over 252 as another example of a basis we might encounter. Let us now transition to discussing spot rates, zero rates, and short rates. A spot rate generally refers to an interest rate effective today and extending over a certain period. It could span from today to tomorrow, or to 3 months, or from today up to 1 year. Sometimes spot may refer to rates beginning on what's known as the spot date, but broadly speaking, it denotes any rate starting immediately and reaching into the future, not really just limited to up to 1 year. A zero rate is a particular type of spot rate, often denoted with Z, and it pertains specifically to continuously compounded interest over time with an established basis such as actual 365. Remember, and eventually this will become intuitive, a zero rate on trading floors typically means a continuously compounded rate with an actual 365 basis. It goes back to the late 90s when interest rate derivatives became common and researchers at Wall Street needed a consistent rate measure across all indices and all currencies. So zero rates were introduced and practitioners adopted it. Based on this definition, we can calculate discount factors from today, T0, until any future time, T1, using the formula e raised to the power of negative z times dt. The basis for dt is calculated by dividing the actual number of days by 365. Now, short rates are a different concept from spot rates. Spot rates refer to the period from today, T0, to a specific future time. On the other hand, a short rate is a mathematical construct. It's an instantaneous short rate. This concept is utilized in quantitative models and forms part of what we call continuous time finance. It's foundational in continuous stochastic interest rate models used by quants and traders. There are various models such as short rate models, spot rate models, or forward rate models. However, a short rate model has a specific meaning. To work with these models effectively requires knowledge of stochastic calculus at a basic level, depending on your quantitative role within a financial institution. A well-known model is the HJM Heath-Jerome-Morton model, which deals with stochastic instantaneous short rates. Following HJM was the LIBOR market model, which focused on modeling 3-month spot rates and forward rates. The LMM has now evolved further to the forward market model, as LIBOR has been replaced by SOFR. The HJM model specifically captures how instantaneous short rates move over brief periods, and they are typically continuously compounded by definition, since they represent an instantaneous measure. These rates aren't directly observable in markets because you can't monitor an instantaneous short rate. It's more of an abstract concept for quant modeling purposes. Nevertheless, understanding these concepts is very good to know, as they serve as building blocks for more complex financial models. Having discussed spot rates, zero rates, and short rates, consider them as different types of interest rates starting from today. We'll move now on briefly to forward rates. Forward rates are particularly important because they define future cash flows in interest rate swaps, which are determined today. To price a swap accurately requires projected cash flows that occur in the future and discount factors to present value these cash flows. Swaps typically have a fixed leg and a floating leg. The floating leg relies on these forward rates. As a forward rate example, let's say today's January 3rd, 2023. Then today's 3-month rate, looking 6 months ahead, would start from July 3rd, covering 3 months, until October 3rd of 2023. That would be defined as today's 3-month rate effective 6 months forward. In our notion, F, the first parameter, indicates when this forward rate is effective, January 3rd, and then follows with both start and end dates of that particular forward interest rate period. Generalization of T0 with T1 and T2, where T1 represents the start date and T2 marks the end of the forward rate period. This forward is established at time T0. These dates have specific start and end points, which are determined by market conditions. For instance, forward rate agreements, FRAs, allow you to trade these forward rates directly. You can also conceive that every forward rate could be implied synthetically through the purchase and sale of various FRAs or swaps. Sell-side market participants must be exceedingly accurate in their forward rate calculations, because inaccuracies might lead to mispricings. If you undervalue an asset, another party might exploit this by purchasing it from you at the lower price, resulting in a financial loss for you. As a final point, I'd like to state that the forward rate is the first derivative or the slope of the zero rate curve. Market participants therefore look at zero rates, discount factors, as well as forward rates, as they are all useful concepts when valuing and managing the risk of interest rate swaps. In conclusion, I hope you found this lecture informative. We began with basic concepts like interest rates and bonds, progressing to how term structures are derived. We defined key constructs such as compounding and basis before discussing spot rates, their conventions, and how zero rates and short rates factor into our analysis. Additionally, we introduced the concept of forward rates and touched upon their connection to forward rate agreements and swaps. As always, if you would like to go deeper into a certain topic, please contact me via the comment section or send me a message to my email directly. I look forward to having you join us for our next session. Thank you very much for your attention.